Before we dive in, please remember that I am not a financial advisor, CPA, or tax professional. This video is for educational and entertainment purposes only. The information provided is based on publicly available data and general principles, and is designed to give you a foundational understanding of how net pay is calculated in the United States. Your individual financial situation is unique, and your specific numbers will be different. Always consult with a qualified professional for advice tailored to your circumstances. This presentation is a guide to help you understand the process, not to give you specific financial advice. You just got the offer. $100,000 a year. The number hangs in the air, sparkling. You did it. You hit the six-figure mark. Your mind immediately starts racing. You pull out your phone's calculator, your fingers flying across the screen. 100,000 divided by 12 months. That's over $8,300 a month. Divided by 2 paychecks. That's more than $4,100 every 2 weeks. You start planning. You can finally move out of that cramped apartment. You can pay off that student loan faster. You can book that vacation to Hawaii you've been dreaming about. Life is about to change. Then 2 weeks later, the direct deposit notification pops up on your phone. Your heart skips a beat. You open your banking app, your eyes searching for that beautiful number. $4,166. But that's not what you see. The number staring back at you is $2,900. Maybe $3,000 if you're lucky. You blink. You refresh the app. It's the same. A cold wave of confusion, and maybe even a little bit of anger washes over you. Where did over $1,000 go? It's just gone. Vanished into thin air between your employer's bank account and yours. This isn't a hypothetical story. This is the brutal reality check that hits millions of Americans every single payday. It's the moment you realize the biggest number in your professional life. Your salary is a fantasy. And here's the secret. The massive multi-billion-dollar payroll and HR tech companies want it to stay that way. They've built incredibly complex software that calculates your pay down to the penny, but they have zero incentive to actually teach you how it works. They give you a pay stub that looks like an ancient scroll written in a dead language. FICA, OASDI, MEDFICA, SUI, FUTA, pre-tax, post-tax. It's a deliberate wall of confusion. They've created a black box. They put your gross pay in one end, perform some digital wizardry you're not meant to understand, and your net pay comes out the other. They sell convenience, not clarity. They sell a service, not empowerment. Why? Because if you're confused, you're dependent. If you don't understand the system, you can't question it. You can't spot errors. You can't strategically plan. You just accept the number they give you, shrug your shoulders, and try to make it work. Well, today that ends. This video is the key to unlocking that black box. We are going to rip it open, expose every gear and wire, and demystify every single line on your pay stub. By the end of this presentation, you will have a superpower. You will be able to take any salary for any job in any of the 50 states and calculate your actual take-home pay with terrifying accuracy. You won't be guessing anymore. You'll know. We are going to build your paycheck from the ground up together. We'll start with your gross pay, and then we will meticulously walk through every single deduction one by one. We'll cover the big ones like federal and state income taxes, and I'll show you how that W-4 form you blindly signed on your first day of work is secretly controlling your financial life. We'll break down the FICA taxes, Social Security and Medicare, the silent partners that take a flat 7.65% from nearly every dollar you earn before you even see it. Then we'll dive into the wild world of state-specific deductions, showing you why a $100,000 salary in Texas feels radically different from that same salary in California or New York. We'll even touch on the pesky local and city taxes that can take another bite out of your income in certain areas. And most importantly, we're going to cover the deductions you actually have control over, the levers you can pull. We're talking about your 401k, your health, dental and vision insurance premiums, your health savings accounts, and your flexible spending accounts. These aren't just expenses. They are powerful tools that can drastically reduce your taxable income, which means you legally pay less in taxes and keep more of your own money. This isn't just an academic exercise. This is about taking back control. The gap between your gross pay and your net pay is where financial anxiety is born. It's the reason over half of Americans can't handle an unexpected $1,000 expense. It's the reason people feel broke even on a good salary. They're budgeting with a phantom number. They're making life decisions based on their gross pay illusion, only to be crushed by their net pay reality. Think of your paycheck like a waterfall. Your gross salary is the massive river at the very top of the mountain. It's powerful and impressive, but as that water cascades down, it hits a series of pools and dams that divert a portion of the flow. The first dam is for the federal government. The next is for Social Security and Medicare. The one after that is for your state government. Then come the dams for your health insurance, your retirement savings, and so on. What finally reaches the lake at the bottom is your net pay, the water you can actually use. Most people just stare at the lake, wondering why it's so small. Our mission today is to climb the entire waterfall. We will inspect every single dam. We'll measure exactly how much water each one is diverting, and we'll understand why. Because once you understand the system, you can navigate it. You can make informed decisions about your W-4 withholdings. You can understand the true cost of an employer's health plan. You can decide exactly how much to contribute to your 401k to maximize your tax savings. This knowledge gives you power in every aspect of your financial life. When you're negotiating a new job, you'll be able to calculate the net difference between two offers, even if they're in different states. You'll be able to create a budget that actually works because it will be based on reality, not a hopeful guess. And you'll be able to scan your pay stub every 2 weeks and know, with absolute confidence, whether it's correct. You'd be shocked how often payroll errors occur. Errors that could be costing you hundreds or even thousands of dollars a year without you ever noticing. The financial world is designed to be complex. It benefits from your confusion, but the core concepts behind your paycheck are not rocket science. They are simple math governed by rules. You just need someone to lay out the rules for you clearly once and for all. That is my promise to you in this video. So forget the number on your offer letter. That number is a marketing tool. It's meant to entice you. The only number that truly matters is your net pay. The number that hits your bank account. That is your financial reality. That is the number you build your life on. Today we are going to close the gap between the illusion and the reality forever. Let's begin. To understand the gap, let's talk about Sarah. Sarah just graduated with a degree in computer science. She's brilliant. She's ambitious. And after a grueling series of interviews, she lands her dream job at a major tech company. The offer letter arrives. Her eyes scan past the legalese and lock onto a single number. $120,000. 120. She does the quick, dirty math in her head. That's $10,000 a month. 10,000. Suddenly, the world opens up. She pictures the apartment she can finally afford in the city, no roommates. The student loans she can aggressively pay down. The trips she can take. The life she can build. Her first month is a blur of orientation, new projects, and meeting her team. It's challenging but exciting. Then the day comes. Payday. The direct deposit notification pops up on her phone. She opens her banking app, her heart thumping with anticipation, ready to see that beautiful 5-figure number. And there it is, $4,862. Wait, that can't be right. She checks again. It's a bi-weekly paycheck, so she multiplies it by 2. $9,724. That's closer to $10,000 but still not quite. But then her stomach drops. That's for the whole month. Not $10,000. It's closer to $6,800. $6,800. Where did over $3,000 go? $3,000 every single month. That's $36,000 a year. Vanished. Poof. Gone. The city apartment suddenly seems a lot smaller. The student loan payments a lot heavier. The dream a little dimmer. This is paycheck shock. And it is the single most common and most jarring financial reality check for millions of Americans every single year. Sarah was sold a number $120,000, but she lives on a completely different number. This chasm between what you're offered and what you receive is what I call the great disconnect. And it is fueled intentionally by the very companies that hire you. Why? Because a big, round, impressive number like 120,000 is an incredible marketing tool. It's a psychological anchor. It makes you feel valued. It wins bidding wars against competitors. It gets you to sign on the dotted line. They are selling you the gross pay, but they know with near-perfect certainty that you will never ever actually touch that amount of money. They have entire departments of compensation analysts and financial experts who understand the labyrinth of deductions better than anyone. But explaining it to you, that's not part of the sales pitch. The messy reality of net pay is a problem for you to solve after you're an employee. So let's solve it. Right now. First, we need to redefine these terms. Gross pay is not your salary. Think of it as the raw material. It's the block of marble before the sculptor starts chipping away. It's the sticker price on a new car. It's a theoretical maximum, an imaginary number that exists only on paper for a fleeting moment before it's immediately carved up. Your net pay or take-home pay is the finished sculpture. It's the out-the-door price you actually pay for the car. It's the only number that represents your actual purchasing power. It is your financial reality. The tools that carve up your gross pay are called deductions, and they fall into three main categories. First, the big one, taxes. These are the non-negotiables, the mandatory contributions to federal, state, and sometimes even local governments. Second, benefits. These are the deductions you often choose, like health insurance premiums, retirement contributions to a 401k, and life insurance. Third, miscellaneous. This is the catch-all bucket for things like union dues, charitable contributions, or payments for a company parking spot. For the rest of this journey, we're going to become sculptors. We're going to take that block of marble, your gross pay, and understand every single chisel and hammer that strikes it. And we have to start with the biggest chisel of them all, federal income tax. This is, for most people, the single largest deduction from their paycheck. It's also the most misunderstood. Most people think that if they earn more money and get bumped into a higher tax bracket, their entire income is now taxed at that higher rate. This is completely 100% false. And this misunderstanding causes people to make terrible financial decisions, like turning down raises for fear of paying more in taxes. The United States operates on a progressive marginal tax system. That sounds complicated, but the concept is beautifully simple if you think of it like filling buckets with water. Imagine a series of buckets, each one labeled with a different tax rate. For 2023, for a single filer, the first bucket is for all your income up to $11,000. Any money that goes into this bucket is taxed at 10%. It's a small bucket with a low tax rate. Once that first bucket is full, the next dollar you earn spills over into the second bucket. This second bucket holds your income from $11,001 up to $44,725. Any money that falls into this bucket is taxed at 12%. Only the money in that specific bucket. The money in the first bucket is still, and will always be, taxed at only 10%. Once that second bucket is full, the income spills into the third bucket, which is taxed at 22%. And so on all the way up the income ladder. There are 7 buckets in total for federal income tax. The percentage on the highest bucket you reach is your marginal tax rate. It's the rate you pay on your last and highest dollar earned, not on all of your dollars. Let's go back to Sarah and her $120,000 salary. She doesn't pay a flat percentage on the whole amount. Her income fills up the buckets one by one. The first $11,000 is taxed at 10%. Her next $33,000 or so is taxed at 12%. Her next $52,000 is taxed at 22%. And finally, only the amount of her salary that spills into the fourth bucket, the portion above $95,375, is taxed at 24%. Her effective tax rate, the actual blended average rate she pays on her entire income, isn't 24%. It's much lower, somewhere around 17 or 18%, once you average out all the different bucket rates. This is the single most important concept you must understand about your pay. You are not taxed at one rate. You are taxed at multiple rates simultaneously. So why doesn't that offer letter from Big Tech come with a simple one-page explainer on this? Why don't they provide a realistic net pay estimate? Because reality is complicated. Reality is less attractive. Selling the dream of $10,000 a month is infinitely more powerful than explaining the reality of filling up tax buckets. They present the illusion of simplicity, leaving you to grapple with the complex truth. They're not breaking the law. They're just winning the psychological game of recruitment. They are leveraging the great disconnect to their advantage. But now, you understand the biggest piece of the puzzle. You understand that your salary isn't a single block of money, but a stream that fills a series of buckets, each taxed differently. This knowledge alone puts you ahead of the vast majority of your peers. You've just taken the first and most critical step to closing that gap between illusion and reality. But the federal government isn't the only one with a chisel. In many places, your state and your city are standing right behind them, waiting for their turn to carve away at your paycheck. And their rules can be even more confusing. It's a tale of two paychecks. Imagine 2 software developers, both brilliant, both working for the same company, pulling in an identical salary of $150,000 a year. One lives in Austin, Texas. The other in San Francisco, California. The developer in Austin opens his paystub and sees a net pay that lets him breathe easy. The developer in San Francisco opens hers and feels a familiar pang of frustration. She's taking home nearly $10,000 less per year than her colleague in Texas. Same job, same salary, same company, but a $10,000 difference. This isn't a hypothetical. This is the brutal reality of state and local income tax. The federal government's chisel is big, but at least it's predictable. It's the same chisel for everyone, no matter where you live. But the moment the feds are done, a whole new set of hands reach for your paycheck, and the size of their chisel depends entirely on your zip code. This is where your gross pay takes its second and sometimes third major hit. Let's start with the dream scenario for many: the states with no income tax at all. As of today, there are 9 of them: Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. If you live and work in one of these states, the state income tax line on your paystub is a beautiful, glorious zero. That entire chunk of money, which can range from a few percent to over 13% in other states, simply doesn't get taken out. Stays in your bank account. For our developer in Austin, this is reality. After federal and FICA taxes, his income tax deductions are done. Finished. Now, the logical question is, how do these states even function? How do they pay for roads, schools, and police officers without collecting income tax? The answer is, they get their money from other places. They just use a different chisel. Texas and Tennessee, for example, have some of the highest sales taxes in the country. So while you're not paying tax on your income, you're paying more every time you buy a car, a coffee, or a couch. New Hampshire doesn't tax earned income, but it does tax interest and dividend income, and it has notoriously high property taxes. So the government always gets its share. The only difference is how they take it. They're either taking it directly from your paycheck before you see it, or they're taking it from your wallet after you've been paid. It's a critical distinction that payroll software completely hides from you, but it dramatically impacts your financial strategy. Now let's leave the tax-free havens and travel to the other end of the spectrum, the states with the sharpest chisels. Welcome to California, Hawaii, New York, New Jersey, and Oregon. Here, the state doesn't just take a bite, it takes a feast. Let's go back to our developer in San Francisco. California has a progressive tax system, much like the federal one, with multiple brackets. That $150,000 salary pushes her into a 9.3% state tax bracket. A 9.3% cut on a significant portion of her income. That's where the nearly $10,000 difference comes from. And California's top bracket, for its highest earners, is a staggering 13.3%, the highest in the entire nation. Think about that for a second. A top earner in California pays their 37% federal tax, their FICA taxes, and then another 13.3% to the state of California. More than half of every additional dollar they earn is immediately gone. Vanished. But here's a secret that the payroll calculators often oversimplify. The top-line percentage isn't the whole story. Just like with federal taxes, state tax systems are a labyrinth of their own unique brackets, deductions, and credits. One state might have a flat tax where everyone pays the same percentage regardless of income. Illinois and Pennsylvania are like this. Another state, like California, has 10 different brackets. A third state might have a high top rate, but it only kicks in for people earning over $1 million a year, meaning it doesn't affect most of the population. This complexity is where people get lost. You might see that 2 states both have a top tax rate of, say, 6%, and assume they're basically the same. But it's not true. State A's 6% might kick in once you earn over $50,000. State B's 6% might not kick in until you earn over $250,000. The effective tax rate, the actual percentage of your total income you pay in taxes, could be wildly different. Your payroll software calculates this correctly, but it never explains the why. It never gives you the context to understand that a move across the state line could fundamentally alter your financial future, even if the new state looks similar on paper. Just when you think you've got your head wrapped around federal and state taxes, just when you think all the chisels have been put away, you hear another sound. It's a smaller chisel, but it's sharp, and it's held by your local government. Yes, on top of federal and state income tax, hundreds of jurisdictions across the United States levy their own income tax. This is the third wave of deductions, and for many, it's a complete surprise. The most famous example is New York City. If you work in the 5 boroughs, you get hit with the trifecta. You pay your federal income tax. You pay New York State income tax, which is already one of the highest in the country. And then, on top of all of that, you pay New York City income tax, which runs up to another 3.876%. It's a tax on a tax on a tax. Let's imagine a third software developer working in Manhattan, earning that same $150,000. Her colleague in Austin pays zero state or local income tax. Her colleague in San Francisco pays about $9,500 in California state tax. Our New Yorker? She'll pay about $8,000 to New York State, and then another $5,500 to New York City. That's a combined state and local tax bill of over $13,500. More than $1,100 a month just for state and city income tax on top of everything else. Same job, same salary, but her take-home pay is in a completely different universe than the developer in Texas. And it's not just New York. All of Maryland's counties and the city of Baltimore have a local income tax. So do major cities in Pennsylvania like Philadelphia and Pittsburgh. Many cities in Ohio, Michigan, and Indiana do too. It's a patchwork quilt of local rules that can make your head spin. Your employer's payroll system handles this automatically, pulling your address and workplace location to apply the right combination of taxes. It's a seamless process for them, but for you it's a black box. You just see the final smaller number on your paycheck, never fully grasping the multiple layers of government that are taking a piece of your labor. This geographic lottery is one of the most significant, yet least understood, factors in personal finance in America. The state, county, and city you happen to call home can have a bigger impact on your take-home pay than a $5,000 raise. It's why you see headlines about mass migrations of people and businesses from high-tax states like California and New York to no-tax states like Florida and Texas. It's not just about politics or weather. It's about cold, hard math. It's about thousands of dollars a year that either stay in your pocket or disappear into government coffers. The system is designed to be confusing. It's a chaotic symphony of federal, state, and local rules that almost no one can fully comprehend. But the rise of remote work has thrown a whole new wrench into this already complicated machine. What happens when your home is in a state with no income tax, but your company's office is in a state with a very high one? What happens when you live in New Jersey, but you commute to your job in New York City? Do you pay twice? Who gets the money? This is where the tax code turns from a rulebook into a tangled web of reciprocity agreements. And it's a trap that costs remote and hybrid workers thousands of dollars every single year if they don't understand the rules. And those rules are what we need to untangle next. At its simplest, a reciprocity agreement is a truce between two states. They agree that they will only tax their own residents, even if those residents earn money across the border. Imagine two neighboring kingdoms agreeing not to tax each other's merchants. Supposed to make life easier. If you live in a state with a reciprocity agreement with your work state, you only have to file and pay taxes in the state where you live. Your employer is supposed to withhold taxes for your home state, not your work state. It's clean. It's simple. And in a perfect world, that's how it would always work. But we don't live in a perfect world. Let's take a software engineer, we'll call her Sarah. Sarah lives in Pennsylvania but works for a tech company with a huge campus in New Jersey. These two states have a reciprocity agreement. So Sarah's company should be withholding Pennsylvania taxes from her paycheck. But here's the trap big tech's automated payroll systems often fall into. The system sees the work address is in New Jersey, and by default it starts withholding New Jersey state income tax. Sarah doesn't notice for a few months. When she finally does, her HR department tells her it's a hassle to change, and that she can just sort it out at tax time. What does sorting it out actually mean? It means Sarah now has to do twice the work. She has to file a non-resident tax return in New Jersey to claim a full refund of every dollar that was mistakenly withheld. At the same time, she has to file a resident tax return in her home state of Pennsylvania and pay the entire year's tax bill in one lump sum, because nothing was being paid toward it throughout the year. So not only is she hit with a massive unexpected tax bill in Pennsylvania, but the money she needs to pay it is being held hostage by the state of New Jersey, and she might not get that refund for weeks or even months. She's out thousands of dollars, all because a payroll system took the lazy way out. This is not a bug. To these massive systems, it's a feature. The burden is transferred to you. Now let's take that same scenario and make it 100 times worse. Let's imagine Sarah lives in Connecticut, but her company's office is in New York City. Connecticut and New York do not have a reciprocity agreement. This is where the game changes completely, and the concept of a tax credit enters the picture. It sounds helpful, but it's often a wolf in sheep's clothing. Because Sarah works for a New York company, her Her employer is legally required to withhold New York State income taxes from her paycheck. No getting around it. But Sarah is a resident of Connecticut, which means Connecticut also wants a piece of that same income. You're probably thinking, wait, so she gets taxed twice on the same dollar? And the answer is, almost. To prevent a full-on taxpayer revolt, states have a system of credits. Sarah will pay her taxes to New York first. Then when she files her Connecticut tax return, she tells Connecticut, hey, I already paid X amount of dollars in taxes to New York on this income. Connecticut then gives her a credit for the taxes she paid to New York. Here is the multi-thousand-dollar piece of information that is buried in the fine print. The credit is only for up to the amount she would have owed in Connecticut on that same income. And here's the problem. New York state tax rates are significantly higher than Connecticut's. Let's say on her $150,000 salary, she owes New York about $8,000. But if she had earned that same money in Connecticut, she would have only owed about $6,500. So, Connecticut will give her a credit for $6,500, wiping out her Connecticut tax bill completely. But what about the extra $1,500 she paid to New York? It's just gone. She doesn't get it back. By living in a lower tax state but working in a higher tax state, she is forced to pay the higher of the two tax rates, effectively losing the entire tax benefit of living in Connecticut. The credit doesn't make you whole. It just prevents a complete disaster. You still lose. But even that nightmare has a bottom. The final, most insidious trap is a rule so bizarre and aggressive it feels like it can't possibly be real. It's called the convenience of the employer rule. And this is the #1 reason why a remote job offer from a company in one state can be catastrophically different from the same offer in another. A handful of states have this rule, but the most aggressive and notorious user is, once again, New York. Here's how it works. Let's say you live in Florida, a state with zero income tax. You get a fantastic, fully remote job offer from a company based in Manhattan. You never have to go to the office. You never set foot in New York State. You sign the offer, celebrating the fact that you'll be earning a New York salary while paying zero state income tax. You'd be wrong. Dead wrong. The convenience of the employer rule states that if you are working remotely for a New York-based company for your own convenience, and not because your employer requires you to work from home, then New York State considers your income to be New York-sourced income. They will tax you as if you were sitting in that Manhattan office every single day of the year. The only way out is if your employer can prove to the state of New York that your job is a bona fide employer-mandated remote position, a standard that is incredibly difficult to meet. They basically have to prove they couldn't host you in the office even if they wanted to. So, you living and working in your home office in Miami will have New York State income taxes withheld from every single paycheck. We're talking about potentially 5, 6, 7, 8% of your gross pay, vanishing to a state you don't live in and whose services you don't use. And because Florida has no state income tax, there's no home state to give you a tax credit. There's no mechanism to get that money back. It is, for all intents and purposes, gone forever. You are paying thousands, potentially tens of thousands of dollars, for the privilege of having a New York-based employer. Why on earth don't they shout this from the rooftops during the hiring process? Because it's a catastrophic disadvantage in the war for talent. If you're choosing between two identical $200,000 remote job offers, and one is from a company in Texas, another no-income tax state, and the other is from a company in New York, the New York offer is not a $200,000 offer. After you pay New York its tribute, it's effectively a $187,000 offer. They are not the same. Big tech and big finance companies based in these states know this. They rely on the fact that most people look at the gross salary number and don't understand the brutal reality of state tax sourcing until their first paycheck is 10% lighter than they expected. And by then it's too late. The paperwork is signed. So you've navigated the federal maze, you've dodged the state-level traps of reciprocity, and the terrifying convenience of the employer rule. You think you've finally figured out the big deductions, but the tax man isn't done with you yet. Because in many parts of America, there's a third layer of taxation that most people forget even exists until it's already been taken from their check. And this is where your zip code, down to the specific street you live on, can literally cost you thousands more than the person living one town over. I'm talking about local taxes. And no, I don't mean property tax or sales tax. I mean local income tax. This is the phantom deduction that haunts paychecks in thousands of municipalities across the United States. And it's the single biggest reason why online net pay calculators are often wildly, dangerously inaccurate. Think about it. You go to one of those slick websites, you type in your $100,000 salary, you select California or Texas, and it spits out a number. But what it almost never asks is, okay, you live in Pennsylvania. But where in Pennsylvania? Do you live in Philadelphia or right outside of it? Do you live in Pittsburgh or a neighboring suburb? Because the answer to that question can change your net pay by over $3,000 a year. Let's make this real. Imagine two software engineers, Alex and Ben. They both just got hired at the same company in downtown Kansas City, Missouri. Same job, same title, same exact salary. $120,000 a year. They're both single, no kids, taking the standard deduction. On paper, they are identical financial twins. Federal taxes, the same. State taxes? Missouri has a flat rate, so yep, the same. FICA taxes? Identical. Alex decides to live the downtown lifestyle. He gets a cool apartment in the city, a short walk from the office. Ben, on the other hand, prefers a quieter neighborhood. He finds a place just a few miles away, a 15-minute drive, in a suburb just outside the city limits. For the first few months, everything seems great. Then they compare pay stubs, and Alex is furious. Ben is taking home almost $100 more every single paycheck. Over the course of a year, Ben will have an extra $1,200 in his bank account. Why? Because Alex's apartment is inside the Kansas City limits. He's subject to a 1% city earnings tax. Ben, living just a few miles away, pays 0. 1% might not sound like much, but it's $1,200 vaporized from Alex's salary simply because of his address. And the net pay calculator he used to budget for his expensive downtown apartment? It never even mentioned this. It gave him a false sense of financial security. It didn't account for the line on the map he chose to live on. And this isn't just a Kansas City thing. Not by a long shot. New York City residents pay an additional city income tax on top of their already high New York state taxes, with rates climbing up to nearly 3.9%. On a $150,000 salary, that's almost $6,000 a year that someone living in the suburbs of Yonkers, just a short train ride away, doesn't have to pay. But the most complex and frankly insane example of this is the state of Pennsylvania. It's a minefield of hyperlocal taxation. They have something called the Local Earned Income Tax, or EIT. There are over 2,500 different local tax jurisdictions in the state. Literally thousands of different rates. You can live on one side of a street and pay a 1% local income tax, while your neighbor across the street, in a different school district or municipality, pays 3.5%. Imagine that. You and your neighbor make the exact same salary, say $80,000. You're paying $800 in local tax. They're paying $2,800. That's a $2,000 difference based on which side of the asphalt your driveway is on. So when a big tech calculator just asks you for your state, Pennsylvania, and then uses some generic statewide average for local tax, it's not just being unhelpful, it's being misleading. There is no meaningful average. The only number that matters is the one for your specific, exact address. These calculators don't ask for your address because that's complicated. It requires a massive, constantly updated database of tax jurisdictions. It's hard engineering. It's messy. It's much easier to just ignore it and give you a clean, simple, and wrong answer. They are prioritizing user experience over user accuracy. They know that if they ask you for your full street address, you might get weirded out. You might abandon the calculator. They want to give you a number in under 5 seconds. But that speed comes at the cost of truth. The secret they won't tell you is that to get a truly accurate number, they would need to know exactly where you sleep at night. And it's not just a single city or county tax. Oh no, it gets deeper. In states like Indiana, you have county-level income taxes. In Ohio, you can have city taxes and separate school district income taxes that you have to pay. In Oregon, there's a TriMet transit tax for the Portland metro area. In cities like San Francisco, they have a gross receipts tax, which is technically on the employer, but you better believe that impacts the overall compensation and hiring budget for employees there. These are not edge cases. We're talking about millions upon millions of Americans living in places like Baltimore, Wilmington, St. Louis, Detroit, Cincinnati, Cleveland, Louisville. The list goes on and on. All of these places have local income taxes that the vast majority of online calculators completely ignore or get horribly wrong. This is a fundamental flaw in their design. They treat the United States as 50 different tax zones. The reality is that it's tens of thousands of different tax zones. Your financial reality isn't defined by your state capital. It's defined by your city hall and your local school board. So when you use that calculator to decide if you could afford a certain apartment, or to compare a job offer in one city versus another, you were likely operating with incomplete data. You were making one of the biggest financial decisions of your life based on a simplification, a convenient fiction. The number it gave you wasn't a precise calculation. It was a ballpark estimate with a margin of error that could be thousands of dollars. And the worst part is, you don't discover this error until you get your first paycheck. You see that number and your heart sinks. It's lower than you expected. You check the math, you look at the federal and state withholding, and it all seems right. And then you see it. A small unassuming line item. City tax. Local tax. SDIT for school district income tax. And you realize you've been blindsided. The budget you so carefully planned is already broken before you've even paid your first month's rent. This is the direct consequence of a system designed for simplicity over substance. Big tech gives you a tool that feels powerful and precise, but the hidden assumptions it makes can be financially devastating. They've built a financial map of the US that's missing most of the local roads. So we've pulled back the curtain on federal taxes, with their brackets and filing statuses. We've navigated the labyrinth of 50 different state tax systems. And now we've exposed the hidden layer of local taxes that are tied to your specific address. At this point, you might be thinking, okay, I get it. Gross pay minus federal minus state minus local. That's my net pay. But you'd still be wrong. Because we haven't even touched the most powerful and strategic part of your paycheck. We haven't talked about the money that disappears before a single dollar of tax is even calculated. These are the deductions that the wealthy and financially savvy use to legally shield huge portions of their income from the IRS, dramatically lowering their tax burden in ways that most people don't even know is possible. And this is where the online calculators fail most spectacularly of all. Because an online calculator has no idea what benefits your specific employer offers. It has no idea about your long-term financial goals, your family's healthcare needs, or your personal risk tolerance. It treats you like a number in a spreadsheet, a generic taxpayer with a salary and a filing status. But your financial life is not generic. And the single biggest thing these calculators get wrong, the area where they completely fall apart, is in the world of pre-tax deductions. Think of your gross pay as a big bucket of water. Before the government can take its share, the taxes, you get the legal right to scoop out some of that water and put it into special protected containers. Every single scoop you take out legally lowers the water level in the main bucket. The government then only taxes the water that's left. The more you scoop out beforehand, the less there is to be taxed. It's that simple. These scoops are your pre-tax deductions, and they are the most powerful tool you have for controlling your take-home pay. The most famous of these is the 401k, or its nonprofit equivalent, the 403b. Most people think of a 401k as just a retirement account. That's like calling a smartphone just a telephone. It dramatically undersells its true power. Yes, it's for retirement, but its immediate effect is as a tax reduction machine. Let's use a simple example. Say you earn a salary of $80,000 a year. If you don't contribute anything to a 401k, the IRS looks at that $80,000 and says, okay, we're calculating your federal income tax based on this entire amount. But let's say you decide to contribute 10% of your salary to your 401k. That's $8,000 over the course of the year. This is where the magic happens. That $8,000 is taken directly from your paycheck before federal and, in most cases, state income taxes are calculated. So the IRS no longer sees you as an $80,000 a year employee. For income tax purposes, they now see you as a $72,000 a year employee. You just legally and instantly gave yourself an $8,000 pay cut in the eyes of the taxman. Your tax bill will be calculated on that smaller number, which could easily save you well over $1,000, maybe even $2,000 in federal income tax alone, depending on your tax bracket. That money, that tax savings, goes directly into your pocket, increasing your net paycheck after check. And we haven't even mentioned the best part, the employer match. Most companies will match your contribution up to a certain percentage, often 3%, 4%, or even 6%. This is, without exaggeration, free money. If you make $80,000 and your employer offers a 5% match, they are literally handing you an extra $4,000 a year just for participating. There is no other investment on earth that gives you an instantaneous 100% return on your money. Not contributing enough to get the full employer match is like taking a portion of your salary and setting it on fire. An online calculator might have a little box for a 401k percentage, but it rarely explains the profound impact of this decision. It doesn't tell you that you're not just saving for retirement. You're actively reducing your current tax burden in a massive way. But the 401k is just the beginning. The next tool is one that financial experts often call the single greatest investment vehicle in existence. It's so powerful it's like a financial superpower. I'm talking about the Health Savings Account, or HSA. If you have a high-deductible health plan, you may be eligible for an HSA. And if you are, you need to pay very close attention. A 401k is great because it has a double tax advantage. Your money goes in tax-free, and it grows tax-free. But an HSA has a triple tax advantage. This is the holy grail. First, just like a 401k, the money you contribute is tax-deductible. It lowers your taxable income right now. For 2024, an individual can contribute up to $4,150, and a family can contribute up to $8,300. So a family making $100,000 could instantly reduce their taxable income to $91,700, saving thousands in taxes immediately. Second, the money in your HSA can be invested, and it grows completely tax-free. No capital gains tax, no dividend tax, nothing. It just compounds year after year, untouched by the IRS. And third, here's the killer feature. When you withdraw the money to pay for qualified medical expenses, the withdrawal is, you guessed it, completely tax-free. It's the only account in America where your money is never ever taxed, as long as you use it for healthcare. And healthcare is defined very broadly. We're talking doctor visits, dental work, prescription drugs, eyeglasses, LASIK surgery, even things like acupuncture and chiropractic care. Unlike other accounts, there's no deadline to use the money. You can pay for a medical expense out of pocket today, save the receipt, and then reimburse yourself from your HSA 5, 10, even 30 years from now after the money has grown exponentially. It becomes a tax-free retirement account for healthcare. An online calculator has no way of understanding this nuance or its impact on your financial strategy and, therefore, your net pay. And there's more. Let's talk about the Flexible Spending Account, or FSA. This is a bit like the HSA's cousin. You don't need a high-deductible health plan to use it. You can contribute a set amount of pre-tax money, up to around $3,200 for 2024, specifically for out-of-pocket medical or dental expenses. Again, this directly lowers your taxable income. If you know you're going to spend at least a couple $1,000s a year on co-pays, prescriptions, new glasses for your kids, or braces, an FSA is a no-brainer. You're essentially getting a 20 to 30% discount on all those expenses because you're paying for them with money that was never taxed. The main catch with an FSA is the use it or lose it rule. You generally have to spend the money within the plan year. But for anyone with predictable health expenses, it's an easy way to boost your take-home pay by lowering your tax bill. Now let's put this all together and see why the online calculators fail so badly. Imagine our employee Alex, who makes $100,000 a year. Alex goes to a popular net pay calculator, types in $100,000, selects single, and hits calculate. The calculator crunches the numbers based on federal tax brackets, FICA taxes, and maybe a standard deduction. It spits out a net pay number. But this number is a fantasy. It's fiction. Because in reality, Alex is smart. Alex contributes 10% to their 401k, which is $10,000. Alex has a family and maxes out their HSA at $8,300. And Alex knows the family will need dental work and new glasses, so they put $2,500 into a dependent care FSA. Let's do the math. $10,000 plus $8,300 plus $2,500. That's a total of $20,800 in pre-tax deductions. So when the IRS looks at Alex's income, they don't see $100,000. They see $100,000 minus $20,800. They see an income of just $79,200. Alex has legally shielded over 20% of their income from taxation. The tax bill on $79,200 is dramatically lower than the tax bill on $100,000. We're talking about a difference of thousands and thousands of dollars a year. The online calculator's estimate would be off by hundreds of dollars every single month. It would have presented Alex with a completely misleading picture of their financial reality, all because it couldn't account for these powerful, personal, and strategic financial decisions. This is what big tech won't tell you. They can't. Their simple tools are designed for a simple world that doesn't exist. They trade personalized accuracy for mass-market simplicity, and in doing so, they fail to show you the most powerful levers you can pull to control your own financial destiny. But what we've just discussed is only half the story of deductions. There's a whole other category of subtractions from your paycheck that happen after taxes are calculated, and these can be just as confusing and just as impactful on your bottom line. And that's before we even talk about the other elephant in the room, the wild, unpredictable world of state income tax. So let's talk about that elephant. State income tax isn't just one system. It's 50 different systems, 50 different philosophies on how to fund a government, all crashing into your paycheck. This is where the simple, clean math of those online calculators completely shatters against the wall of reality. Because your location isn't just a pin on a map. It's one of the single biggest variables in your net pay equation. First, you have the states that play on easy mode. We're talking about the 9 states with no state income tax at all. Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. If you live and work in one of these states, your life is simpler. Your state tax column is a beautiful, glorious zero. This is a massive advantage. Imagine 2 software engineers, Sarah in Austin, Texas, and David in San Francisco, California. They both earn $150,000 a year. They both have the same 401k contributions and the same federal tax withholdings. Yet, Sarah in Austin will take home over $10,000 more per year than David. Not because she's a better negotiator, not because her company is more generous, but simply because of her zip code. Now, big tax calculators can handle this. They have a drop-down menu. You pick Texas, it removes the state tax. Simple. But what they don't tell you is the why. States without an income tax aren't running on charity. They have to make up that revenue somewhere else. Texas and Tennessee, for example, have some of the highest combined state and local sales tax rates in the country. New Hampshire taxes interest and dividend income, and many of these states rely heavily on property taxes. So while your paycheck is bigger, your cost of living in other areas might be higher to compensate. It's a shell game, and you need to see all the shells to know if you're truly winning. Next up on the complexity ladder are the flat tax states. States like Colorado, Illinois, Indiana, and Pennsylvania. Here the idea is simple. Everyone pays the same percentage regardless of income. In Colorado, it's 4.4%. Whether you make $40,000 or $4 million, the state takes 4.4% of your taxable income. It's predictable, it's easy to calculate, but it's a world away from the federal system. There are no brackets to climb. It's a straight, flat road. Again, most online calculators can handle this just fine. They plug in the single rate and you're done. But they miss the nuance. They don't explain that this flat rate often replaces a complex system of deductions and credits you might find in other states, potentially making the lower flat tax more expensive for some families than a higher progressive tax elsewhere. And that brings us to the final boss, the progressive tax states. This is the majority of the country, and it's where the real chaos begins. Just like the federal system, these states have tax brackets. The more you earn, the higher the percentage you pay on your next dollar of income. But here's the catch. Every single one of these states has its own unique set of brackets, its own rates, and its own rules. It is a labyrinth of legislative madness. Let's take California, the poster child for tax complexity. California doesn't just have a few tax brackets, it has 10. It starts at 1% on your first $10,000 of taxable income. Then it jumps to 2%, then 4%, 6%, 8%, 9.3%. It keeps climbing until it hits a staggering 13.3% on income over $1 million. This is the highest top marginal state tax rate in the entire country. That $150,000 salary for David in San Francisco? He's not just paying one rate. He's paying 1% on his first chunk of income, 2% on the next, and so on all the way up to the 9.3% bracket. His effective state tax rate is a blended average of all those brackets he passed through. But wait, it gets worse. Because California has another little surprise for you called State Disability Insurance, or SDI. This is not an income tax. It's a mandatory deduction managed by the state to provide disability and paid family leave benefits. For 2024, it's 1.1% of your wages, up to a maximum wage limit of over $160,000. It's another 1.1% of your gross pay that just vanishes, up to a maximum of over $1,700 a year. It comes out of your check, it's calculated by the state, but it's not technically income tax. Did the quick and easy online calculator you used mention SDI? Did it ask if you were in one of the few states that have this mandatory program? Almost certainly not. It's a detail, a nuance, and those tools are built for speed, not accuracy. They sand down the complex edges of reality to give you a smooth, simple, and ultimately incorrect number. And this isn't just a California problem. Every state has its own quirks. You think you're safe in New York? Their state tax brackets top out at 10.9%. But if you live or work in New York City, you get hit again. The city itself levies its own personal income tax, with rates that climb up to nearly 3.9%. So a high earner in Manhattan isn't just paying federal tax and New York state tax, they're paying a third layer of New York City tax. That's a combined top marginal rate that rivals California's. How about Oregon, with a top rate of 9.9% that kicks in at a relatively low $250,000? Or Minnesota, with 4 brackets topping out at 9.85%? The permutations are endless. And this is what the big tech payroll companies don't advertise. They don't show you the messy, complicated state-by-state engine running under the hood. They just give you a single, clean output, hiding the dizzying complexity that got you there. And the complexity doesn't stop with where you live. What about where you work? Millions of Americans live in one state and commute to another for their job. Think of people living in New Jersey or Connecticut and working in New York City, or living in Washington and working in Oregon. This creates a tax nightmare. Which state gets to tax your income? The one where you lay your head at night, or the one where your office is? The answer, in many cases, is governed by something called a tax reciprocity agreement. This is a deal between 2 neighboring states that says, look, let's make it easy on our residents. They will only pay income tax to the state where they live, not where they work. Pennsylvania and New Jersey have a famous one. If you live in Philly and work in Camden, you only pay Pennsylvania tax. Simple. But what if there isn't a reciprocity agreement? This is where you can get into real trouble. If you live in Connecticut and work in New York, for example, there's no agreement. In this scenario, you generally owe tax to New York first as the state where you earn the money. Then you also have to file a tax return in your home state of Connecticut. Connecticut will give you a credit for the taxes you paid to New York, so you're not fully double taxed. But the paperwork is a nightmare. And because the tax laws and rates are different, that credit might not cover the full amount, leaving you to pay the difference. This is a level of personal finance nuance that a simple online calculator cannot possibly comprehend. It asks for your state. But what does that even mean in this context? Your home state? Your work state? The tool has no idea. It just assumes they're the same because that's the simple 90% case. But for the 10% of people in that situation, the calculator isn't just wrong. It's dangerously misleading. The difference between California's SDI, New York City's local tax, and a reciprocity agreement between 2 states isn't a rounding error. Can be thousands, even tens of thousands of dollars a year. It's the difference between a comfortable budget and a financial shock. These are the details that matter, the details that determine the real number. So we've navigated the labyrinth of federal taxes and waded through the swamp of state and local taxes. You think finally we're done. You'd think the number you have now is what you take home. But you'd be wrong. Because now we have to talk about the money that comes out of your check after all of this. The voluntary, the mandatory, and the downright bizarre deductions that have nothing to do with the government but have everything to do with how much you actually get to keep. Let's start with the giants, the ones that can take the biggest bite out of your paycheck before you even see it. These are your benefits deductions, and while they might feel like another tax, they operate in a completely different universe. And this is where the payroll software starts to obscure a powerful truth. It shows you a number, a line item labeled health insurance, and subtracts it. Simple. But what it doesn't tell you is the financial alchemy happening behind the scenes. For most people, health, dental, and vision insurance premiums are deducted pre-tax. This is a profoundly important concept that is almost never explained properly. When a deduction is pre-tax, it means the money is taken out of your gross pay before any income taxes are calculated. Think about that. If you make $5,000 and your health insurance is $500, the government doesn't calculate your tax based on the $5,000. It calculates it based on $4,500. You are literally lowering the amount of your income that is taxable. So that $500 deduction doesn't actually reduce your take-home pay by $500. It might only reduce it by $350 or $400 depending on your tax bracket. You're paying for a critical service with partially untaxed dollars. This isn't a loophole. It's a feature of the system. But the software just shows a minus sign. It doesn't show the invisible plus sign you got on your tax calculation because of it. Then comes the second giant, and arguably the most important financial decision you'll make at your job: your retirement savings. the 401k, or for nonprofits, the 403b. Again, the software shows a line item, 401k contribution, a number, a subtraction. But this isn't a cost. This is you paying your future self. It's a transfer of wealth from your present pocket to your future security. And the way you do it matters immensely. You'll typically have two choices: a traditional 401k or a Roth 401k. A traditional contribution is pre-tax, just like the health insurance we talked about. You get the tax break now. The money goes in untaxed, it grows untaxed, but you'll pay income tax on it when you withdraw it in retirement. A Roth contribution is the opposite. It's post-tax. The money comes out of your check after income taxes have been paid. Feels like it costs you more today because it does. But the magic is, it grows completely tax-free. And when you withdraw it in retirement, it is 100% yours. Zero tax is owed. Which one is right for you is a huge debate, but here's the secret big tech absolutely won't tell you, because it has no way of knowing your company's policy: the employer match. Many companies will match your contributions up to a certain percentage. They might say, "We'll match 100% of your contributions up to 3% of your salary." Let me translate that for you. That is a guaranteed, risk-free 100% return on your investment. If you aren't contributing at least enough to get the full company match, you are voluntarily taking a pay cut. You are leaving free money on the table. A payroll system will happily let you contribute 0%. It will not flash a big red warning sign that says, "You are turning down a 3% raise." But that's exactly what you're doing. Now let's get even more strategic with two acronyms that can be financial superpowers: the HSA and the FSA. The Health Savings Account and the Flexible Spending Account. An FSA is a pre-tax account you can use for medical expenses. You decide at the beginning of the year how much to put in, and it's deducted from each paycheck. The catch? It's often use it or lose it. If you don't spend it by the end of the year, that money can vanish. But the HSA? Oh, the HSA is different. If you have a high deductible health plan, you may be eligible for a health savings account, and it is the single greatest savings tool in the entire United States tax code. It has a triple tax advantage. 1. The money goes in pre-tax, lowering your taxable income, just like a traditional 401k. 2. The money can be invested and grows completely tax-free. 3. When you withdraw the money to pay for qualified medical expenses, it comes out completely tax-free. There is no other account like it. It's a retirement account disguised as a healthcare tool. Payroll software just sees it as another deduction. It doesn't tell you that you're funding a tax-free investment vehicle that could one day be worth hundreds of thousands of dollars. Those are the big voluntary ones. You might also see smaller deductions for things like group term life insurance or short-term and long-term disability insurance. These are safety nets, and whether you need them depends entirely on your personal situation. But not all non-government deductions are voluntary. Some are mandatory. If you work in a unionized job, you will almost certainly see a deduction for union dues. This is your contribution to the collective bargaining power of your union, funding its operations, negotiations, and support for members. And then there's a category that no one wants to see: wage garnishments. This is when a court orders your employer to withhold a certain amount of your earnings to pay off a debt. This could be for anything from unpaid taxes and student loans to child support or alimony. Your employer has no choice here. They are legally required to comply with the court order and send that money directly to the creditor or agency. The payroll system processes this mechanically, a cold, hard number that tells a much more complicated human story. And finally, we arrive at the downright bizarre. The little nicks and cuts that can leave you scratching your head. Ever seen a deduction for uniforms? Some companies will charge you for the very clothes they require you to wear to work, deducting it slowly over several paychecks. How about a deduction for parking? Yes, some employers will charge you for the privilege of parking your car on their property, so you can come inside and make them money. Then there are the voluntary deductions that don't feel very voluntary. The pressure to donate to the company's preferred charity through payroll deduction. The form lands on your desk, your manager is watching. Is it really a choice? The software doesn't care. It just processes the transaction. You might even see a $2 deduction for a sunshine fund or coffee club. A tiny fee to keep the break room stocked. These aren't illegal, but they are part of the complex tapestry of your net pay. Each of these deductions, from the strategic, wealth-building power of an HSA to the frustrating $5 fee for the coffee you barely drink, is a story. It's a decision, a requirement, or an obligation. A simple payroll software interface flattens all of this into a list of subtractions. It removes the context, the strategy, and the story. It tells you what was deducted, but it will never tell you why, or whether you should change it, or how a simple tweak to your 401k contribution could be worth $1 million in the long run. It presents your paycheck as a simple math problem, when in reality, it's a strategic financial document. So we've dissected your gross pay. We've navigated the maze of federal, state, and local taxes. And now we've uncovered the entire universe of other deductions that stand between your salary and your bank account. You think that's it. You think if you add it all up, it should finally make sense. But what happens when it doesn't? What happens when you look at that final number, that net pay, and something still feels wrong? Because it often is. The systems that run all of this are powerful, but they are not perfect. And the mistakes they make are almost never in your favor. And the most insidious part? These aren't grand, elaborate schemes hatched in a secret boardroom. They are quiet digital errors. A single line of faulty code. A data entry mistake made by an overworked HR assistant months ago. A software update that didn't quite mesh with an older payroll module. These are the ghosts in the machine, and they are quietly picking your pocket every 2 weeks. Think of your company's payroll system as a giant automated chef. Your employment data, your salary, your hours, your tax forms, your benefits choices, that's the raw ingredients. The software is the recipe. It chops, dices, mixes, and bakes, and at the end, it's supposed to serve you a perfectly cooked meal. Your net pay. But what happens if someone puts salt in the sugar container? What if the oven temperature is off by 50 degrees? You get something that looks like a meal, but it tastes wrong. You know it, you can feel it, but you can't always point to the exact ingredient that ruined it. This is the illusion of infallibility that big tech sells. They sell these complex, multi-million-dollar human capital management systems to corporations with the promise of robotic precision. They promise to eliminate human error. But they've just replaced one set of potential human errors with another, more opaque set of system and data errors. And because it's a computer, everyone just assumes it's correct. Who are you to argue with the algorithm? Let's pull back the curtain and expose the usual suspects, the most common payroll errors that these systems either cause or fail to catch. First, and arguably the most devastating, is misclassification. This is the atomic bomb of payroll errors. In the United States, you are generally classified as either exempt or non-exempt. Non-exempt means you are entitled to overtime pay, time and a half, for every hour you work over 40 in a week. Exempt means you're not. This status is determined by federal and state law, based on your salary and, crucially, your job duties. It's not something your employer just gets to decide. But what if the system has you flagged incorrectly? What if you were hired as a salaried, non-exempt employee, but someone ticked the exempt box in the software? Suddenly, all those late nights, those weekend shifts you pull to meet a deadline, are worth exactly $0 extra. You could work a 60-hour week, and your gross pay would be identical to a 40-hour week. The software doesn't know you were grinding until 10 p.m. It only knows the box that says exempt. It follows its programming, and its programming is based on one wrong click made months or even years ago. You're not being paid for a third of your work, and the system that's supposed to protect you is the very tool enforcing the error. This isn't a rounding error. It's digital daylight robbery. Next up is the silent killer: incorrect tax withholding. You fill out a W-4 form when you start a job. You claim your filing status, dependents, and other adjustments. This form is then manually entered into the payroll system. Now, imagine the sheer volume of paperwork an HR department handles. Is it really so hard to believe that your married 3 dependents gets keyed in as single 0 dependents? To the software, it's just data. But to you, it's the difference between a comfortable paycheck and a financial squeeze. The system will now withhold a much larger chunk of your income for taxes, based on that single data entry mistake. You'll probably get it back a year later in the form of a big tax refund. But a tax refund isn't a bonus. It's an interest-free loan you were forced to give the government because of a typo. It's your money that you could have used for bills, for groceries, for investments, held hostage for up to 16 months. Then we have the zombies. Ghost deductions. You had supplemental life insurance 2 years ago, but you canceled it during the last open enrollment. But did anyone tell the payroll software? Did someone go in and manually uncheck that box? Or is that deduction still shambling on? A zombie fee eating a little piece of your paycheck every single cycle? The same goes for a 401k loan you've already paid off, a gym membership you no longer have, or a health insurance premium for a plan you switched away from. These systems are great at starting deductions, but they often have amnesia when it comes to stopping them. And because these are often small amounts, $20, $30, maybe $50, they fly under the radar. But $30 a paycheck is $780 a year. It adds up. And let's not forget the glitches in timekeeping itself. This is where the tech actively works against you. Many automated time clock systems are programmed to round your punches. So you clock in at 7:56 a.m., and it rounds it up to 8 a.m. You clock out at 4:58 p.m., and it rounds it down to 4:45 p.m. It's just a few minutes here, a few minutes there. Who cares, right? You do. Your employer is legally required to pay you for all time worked. Those few minutes are wage theft, laundered through an algorithm. Over a year, those rounded minutes can add up to entire days of unpaid work. The software vendor will tell your company this is for administrative convenience. But it's a convenience that only ever seems to benefit one side. This is the secret they don't want you to fully grasp. The sheer fragility of the system. It's a complex chain, and a break anywhere along it, from your initial W-4 to the data entry to the time clock to the core processing software to the bank transfer, can cost you money. So what can you do? You can't just trust it. You have to verify. You have to become your own forensic accountant. And this is not as intimidating as it sounds. The first step is to gather your evidence. Find your original offer letter. This document contains your official salary or hourly rate. It is your source of truth. Next, pull up your last 3 pay stubs. Don't just look at the net pay. Look at everything. Start with the gross pay. If you're salaried, is the gross pay for the period what you expect? It should be your annual salary divided by the number of pay periods in the year. If you're hourly, do the math. Multiply your hours worked by your hourly rate. Does it match? Check the overtime. Was it calculated at time and a half? Then move to the deductions. Go line by line. Federal income tax, Social Security, Medicare. These are standard. But then look at the voluntary deductions. The health insurance premium. Does it match the plan you know you signed up for? Your 401k contribution. Is it the percentage you elected? Do you see any deductions you don't recognize? Any of those zombie deductions for benefits you canceled long ago? This is your personal audit. You are checking the machine's work. You are treating your pay stub not as a simple statement, but as a crime scene. And you are looking for clues. Because the uncomfortable truth is, no one else is going to do this for you. Your HR department is managing hundreds, maybe thousands of employees. The payroll tech company is managing millions of transactions. They are looking at the forest. They will not see that one sick tree. Only you can. But finding the mistake is only the first and honestly the easiest part. Now comes the real challenge. You found the evidence. You know for a fact that you are being underpaid. What do you do now? How do you approach your company with this information? How do you get what you are owed without being labeled a troublemaker, without damaging your reputation, and without putting your job at risk? There is a strategy for this. A playbook for correcting the record and recovering your money. And getting it wrong can be even more costly than the initial error itself. First, let's reframe the entire situation. Approaching your company about a pay error is not a confrontation. It is a collaboration. You are not an accuser. You are a partner in ensuring accuracy. This is not about blame, it's about clarity. Once you adopt this mindset, every step that follows becomes infinitely easier and more effective. The playbook starts long before you ever type an email or pick up the phone. It begins with absolute certainty. We'll call this step 1, the triple check verification. You cannot walk into this conversation with a vague feeling that something is wrong. You need irrefutable, specific data. First, rerun your own calculations. Use a completely different, reputable online payroll calculator than the one you used before. See if you get the same result. Play devil's advocate and try to prove yourself wrong. Second, review your pay stub again, but this time with a magnifying glass. Compare it line by line against your W-4 selections and your benefits enrollment documents, which you should have saved. Is the filing status correct? Are the pre-tax deductions for your 401k and health insurance exactly what you signed up for? Third, and most critically, you must isolate the exact point of failure. Don't just say, "My net pay is wrong." Say, "My federal income tax withholding appears to be calculated based on a single filing status, but my W-4 is set to married filing jointly." The more specific you are, the faster the resolution and the more credible you appear. Step 2. The dossier of truth. Before you initiate contact, you assemble your evidence. This isn't for a courtroom. It's to make the process as simple and painless as possible for the person who has to help you. Create a single digital folder or have physical copies of these items: your incorrect pay stub, a previous pay stub that was correct, if available, a copy of your W-4, and a printout of your benefits elections. Then create a simple one-page summary. Few bullet points. Gross pay $3,000. Expected federal withholding, based on MFJ status $250. Actual federal withholding on pay stub, $410. Discrepancy, $160. This dossier does two things. It proves you've done your homework, and it gives the payroll professional everything they need to investigate without having to ask you a dozen questions. You are leading them directly to the problem. Step 3. Identify the right point of contact. This is a common misstep. Do not go to your direct manager. Seems like the natural thing to do, but it's often the wrong move. Your manager likely has zero visibility into payroll calculations. They didn't process it and they can't fix it. Complaining to them puts them in an awkward position as a middleman, and any information they give you is secondhand at best. Your target is the source. Look on your company's internal website, in the employee handbook, or on the pay stub itself for a contact email or phone number for the payroll department or HR services. This is your starting point. You want to talk to the person who can actually pull up your file and see the numbers. Now for the most important part of the entire process. Step 4. The perfect email. The tone and wording of your initial communication will set the stage for everything that follows. Your subject line should be clear and professional. Question regarding paycheck for pay date. Your name. The body of the email needs to be a masterclass in non-confrontational inquiry. Start politely. Hi, payroll contact name. I hope you're having a great week. I'm writing with a quick question about my most recent pay statement. Then, present the facts from your dossier. I was reviewing my pay stub for the period ending date and noticed a potential discrepancy I was hoping you could help me clarify. Based on my W-4, I expected my federal withholding to be in the range of your calculated amount, but my pay stub shows a deduction of amount on stub. And now the single most important sentence you will write. Could you please help me understand how the amount on my pay stub was calculated? This is the magic phrase. It's not an accusation. It's a request for education. You are positioning them as the expert and yourself as someone seeking to understand. It completely disarms any potential defensiveness. Attach your one-page summary and the supporting documents you gathered in Step 2, and end with a simple, "Thank you for your time and assistance with this. I really appreciate your help." Then you wait. Step 5. The art of the follow-up. Payroll departments are often busy, especially around pay periods. Give them at least 3 to 5 business days to respond. If you don't hear back, your follow-up email is just as crucial. Forward your original message and add a simple note at the top. Hi, payroll contact name. Just wanted to gently follow up on my email from last week when you have a moment. Thanks so much. No pressure, no annoyance. If they respond and claim the calculation is correct, this is where your preparation pays off. You can reply with, "Thank you for looking into it for me. I'm still having trouble matching that number on my end. To help me reconcile my records, would it be possible to get a breakdown of the calculation you're seeing? It would be a great help for my own understanding." You are consistently, politely, and relentlessly pointing back to the data. You aren't arguing. You are simply trying to make the numbers make sense. In the rare event you are being completely stonewalled, you move to Step 6, the reluctant escalation. This is the last resort. Your next step would be to find the contact information for the head of payroll or the director of HR. You use the exact same process. A polite, evidence-based email. You can even mention your previous attempts to resolve it framed positively. I've been in touch with original contact, but we haven't been able to get to the bottom of it yet, and I was hoping you might be able to offer some additional insight. You are showing that you are following the chain of command and are doing everything possible to resolve it internally. The goal is always to find a solution, not to win a fight. Finally, we arrive at the resolution. Once the error is identified and they confirm a correction will be made, and it almost always is, your job is not done. Your final move is the gracious close. Send a thank you email. Thank you so much for your help in tracking this down and getting it corrected. I truly appreciate you taking the time to resolve it. This small gesture rebuilds any friction, leaves a lasting positive impression, and reinforces your reputation as a reasonable, professional employee. Then, when the correction is made, either as a separate check or on your next paycheck, you verify it. And you check the next one after that. Trust, but always verify. What big tech and the massive payroll processors won't tell you is that their systems, for all their power and complexity, are still just tools. They are configured by people, and their outputs are managed by people. And people make mistakes. Data gets entered incorrectly. A box gets checked wrong. A software update creates a new bug. The system is not infallible. It's a black box, but it is not a perfect box. The lie is that this process is too complicated for you to understand, that you should just trust the final number. But over a career of 40 years, trusting the black box can be the most expensive financial mistake you ever make. This isn't just about one paycheck. It's about a fundamental shift in ownership. Your career, your salary, your financial future. It's all yours. The single greatest tool you have for building wealth isn't a stock or a piece of real estate. It's your income. And protecting and understanding that income is not your employer's primary responsibility. It is yours. By understanding how your pay is calculated, you are no longer a passive recipient of a mysterious number. You are an active, informed participant in your own financial life. You can plan more accurately for taxes. You can optimize your withholdings to either get a bigger paycheck or a bigger refund. You can spot errors that could cost you thousands. You transform from a passenger to the pilot of your own earnings. The person most invested in your money, the person who cares the most about every single cent, has to be you. So, the next time that direct deposit hits, don't just look at the net amount. Open the stub. Read the lines. Understand the story it's telling you. Because your paycheck is the financial autobiography of your career. And you are the only one who can write the ending.